Uwe Parpart, Chief Strategist and Head of Research at Reorient Group, joins us live from Hong Kong. Uwe, good morning and thank you for joining us. Let's start with the big talking point, and the big talking point is China. The economic data from China is looking stable, and one is getting a sense that for the Chinese economy, the storm has come and gone.
Well, I don't know if the storm has come and gone. We were never that negative on China and saw it never as a hard landing risk as many short sellers in the United States wanted people to believe. So, however, there's no question that in the second half of the year, the Chinese economy is picking up momentum, and I think the gratifying thing for Chinese policymakers is that this momentum is largely driven by domestic demand, and I think that's what China wants, that China needs, and it's going in the right direction.
Uwe, what's the sense that you're getting after the US GDP figures and, of course, the jobs data as well? Does it seem like tapering could now happen in January and maybe not, in mid-2014?
Well, it's difficult to say. I have sort of given up on trying to predict what the FOMC is going to do in the United States. They've been so inconsistent in their policy-making communications that it's very, very difficult to make, sense out of it. But, mind you, the GDP was not very good, except for inventories and net exports, which were driven up by lower imports. There was nothing to write home about. As far as the job figures are concerned, yes, we had more jobs than expected, but we had fewer aggregate working hours, which means that the economy is not actually picking up steam. And under those circumstances, we expect the full-year GDP to be at 2%, which is well below the Fed's expectations of 2.3%. So, they may taper in January. They may do it in March. I think mid-2014 is too late. Our prediction is at the moment for March.
Even just about everyone on the street is convinced that US Fed will eventually taper. Do you think tapering could more be like a no event, because this time around the world is prepared for it?
Yeah, I mean, if you look at it right now, they're buying 85 billion in bonds of various kinds per month. If we start reducing that by 10 or 15 billion per month over a certain period of time, I don't think it's going to make that much of an impact. I think the fear and concern of it beforehand is much larger than what will actually happen in terms of the withdrawal of liquidity. The risk is to emerging markets, because the money will first be pulled out from emerging markets, as we already saw in the May, June, July period. And I think this is something that investors, whether it's in India or in China or elsewhere around the Asian region, other than Japan, of course, have to be very, very careful about.
Right. Okay, final question. 2013 has been an extremely volatile, or it has been an extremely volatile year for emerging market equities. Do you think for 2014 we could be in for a stable kind of an environment?
No, I do not believe so. I think the equities will tend to move with the fixed income instruments. And I think there are any number of reasons why fixed income, why bonds will remain volatile. There are many reasons why currencies will probably remain volatile. So the policy-driven markets are always going to be very, very jittery. If we were driven by earnings, if we were driven by fundamentals, yes, we could have more stability. But as long as markets are driven by policy events, I think there's going to be continued volatility in markets.
Right. We appreciate your time and thank you for joining us.